What's going on, everybody? Liam O'Reilly, Vermont Economic Realtor with Jerry Riley Real Estate. I hope you're doing well. We saw mortgage rates tick down this week, as well as the 10-year Treasury. The reason why this is important is because mortgage rates tend to follow what the 10-year Treasury does. But although mortgage rates tick down, they didn't drop as much as the 10-year Treasury. And I think we're starting to see some divergence between what the 10-year Treasury does and what mortgages do, what mortgage rates are doing and how they behave. And this is very important because as we move into 2024, the Federal Reserve is expected to start dropping their Fed funds rate, to start lowering short term interest rates, which is going to have an effect on mortgage rates. But if we see a divergence between bond rates and mortgage rates, in other words, if the spread between what the 10-year Treasury is and where mortgage rates are grows, then even if the Federal Reserve cuts their rates drastically, mortgage rates could remain relatively high, at least high relative to 10-year Treasury notes, to the base mark where most people look to see where are mortgage rates heading. So let's get into some charts. Let's look at a few different articles here, and I'll explain a little bit more about what I'm talking about. So the first thing that we're going to look at here is this chart on FreddieMac.com. Now, this is the mortgage rate chart for it looks like this past year or so. So you can see what the blue line, which is the 30-year fixed rate mortgage, which is what most people get when they purchase a property, is doing right now. And you can see here we have the date down at the bottom. So October 26th, it was at almost 8%. November 2nd, again, almost 8%. And then we saw this big dip. And we saw that in bonds as well. As bonds came down, we saw this big drop in mortgage rates to around 7.5%. But then bonds dropped even further this week, and we didn't see mortgage rates come down quite that much. It's at 7.44%. So here's what I'm talking about with the US 10-year Treasury. And this is what the 30-year fixed rate mortgage most closely follows. And we'll talk about why it follows that in a minute here, but we can see uh, October 26th, it's at around 4.8%, 4.9%. And then we have this big dip here from 4.875 all the way down to 4.55. So almost 30 basis points here between October 30th and November 2nd, November 3rd. And then we see it flatten out a little bit. And now, just at the beginning of this week here, November 13th, it was at 4.63%. And then it drops down to 4.4% the next day on November 14th. So a 20 basis point drop in one day. And then when we go back and we look at what mortgage rates are doing, they're staying relatively stable. It only dropped by 6 basis points. So what does that mean? Why do I think that is surprising? Obviously, because the 10-year Treasury, the mortgage market most follows the 10-year Treasury over any other Treasury market, over any other bond market. Now, they're not directly influenced by each other, right? If one goes down, the other doesn't necessarily need to go down, but they usually behave together. So the fact that we're seeing less a higher mortgage rate relative as the 10-year Treasury rate is dropping, to me shows that there's some sort of divergence going on, that essentially what I think is happening is more people are rushing into the 10-year Treasury and less people are purchasing mortgage-backed securities right now. And I think there's a few reasons behind that. The first is that there's so much availability of treasuries right now. There's been a lot of issuance this past year. The Federal Reserve stepped out of the market. There's going to be more issuance as the U.S. government just pushed back their debt limit, the government shutdown that was averted before the holiday season here, before Thanksgiving. And as the U.S. continues to issue more debt, there's more debt for people to buy. And if rates are where they are right now at around 4.5%, then there's less need for somebody to take a riskier investment and purchase a mortgage-backed security, which is keeping mortgage rates high. And so basically, to sum that all up, what I think is going on is people are buying a lot of treasuries and they don't have that much money left over to roll into mortgage-backed securities because there's so many treasuries available to buy, and because the rate on these treasuries is so high and so attractive, people are rushing into these high rates before the Federal Reserve cuts their rates, which is going to bring, treasuries down. They're going to get a worse return moving into the future if the Federal Reserve cuts rates in 2024 like they're expected to. And that's leaving less money left over for mortgage-backed securities, for mortgage rates to come down. So let's get into a couple different articles that illustrate what I'm talking about. So here's some articles about what happened in the bond market. So basically, this article is talking about how bond yields, or how bond prices have been getting crushed for the past 2 years as rates have risen, prices have fallen. But over this past week, we saw rates start to drop as more people rushed into these bonds. And what they're saying, in this article here is that rate traders are now betting that the Federal Reserve is done hiking and that it will cut borrowing costs by almost 100 basis points next year, starting around mid 2024. So, right, what they're doing is they're going to cut rates, which means these investors will get a worse return a year from now. So they want to rush in and buy the treasuries while they still can. And we're seeing that move out of the Fed's reverse repo facility as well, which the reverse repo pays a overnight rate. It's what the Fed funds rate is what rate they're targeting to pay out in interest to people who hold money in their reverse repo facility and their other facilities. But it's dropping to under a billion or under $1 trillion right here. Right at the top, 993 billion dollars on Thursday, which is the first time it fell under $1 trillion and since August 10th, 2021, after hitting a record high of 2.5 trillion in December 30th, 2022. So why would people take their money out of this risk-free overnight investment where they get 5.5% on an annualized basis? And they get paid that overnight. There's really no risk in keeping your money there. Well, the reason why you would take your money out of this facility is if you think rates are going to drop into the future. Because if the Federal Reserve all of a sudden cuts their Fed funds rate by 100 basis points and it goes from 5.25% all the way down to 4.25%, then that risk-free overnight return isn't as attractive. You're getting a worse rate for the money that you keep in there. So you might as well push that money into U.S. Treasuries if there's Treasuries available, which right now there's a lot of Treasuries available, and get that return for a guaranteed rate of time. In our case, what we're talking about, 10 years for the 10-year Treasury. So why is this important for home buyers and sellers? Why does this matter for you if you're looking to purchase a home? Well, I think the big thing, if you're looking to purchase a home, if the Federal Reserve cuts rates and they cut them significantly, it doesn't necessarily mean that mortgage rates are going to fall significantly. People forget that a big part of what kept mortgage rates so low for the 2010s is that the Federal Reserve was buying these mortgage-backed securities, which was keeping the rate low. The Federal Reserve is not an institution that's built to generate a return for the work that they do based on their investments. They are built to keep low or stable inflation, stable prices, and low unemployment. And so if the Federal Reserve isn't manipulating this market, isn't buying mortgage-backed securities, then it's really up to the other investors, the other institutions, the governments out there who invest in U.S. Treasuries and U.S. investments like mortgage-backed securities to dictate where the mortgage rate is going to be. And with a bunch of new treasuries that are likely going to be issued whenever we do extend the debt ceiling for a longer period of time. I know it got pushed back till January and February till after the holidays, but whenever the government comes to an agreement on how much new debt they're going to issue, then there's going to be even more treasuries available for people to purchase. And unless the Federal Reserve steps in to buy those US treasuries or steps in to buy these mortgage-backed securities, then I think even if they drop their Fed funds rate, we could see a larger divergence between the 10-year treasury and where mortgage rates are, because investors only have so much money to invest. And if they're spending all that money on US treasuries, that means less money going into mortgage-backed securities, which means if they're gonna put the limited money they have into those mortgage-backed securities, they gotta get a good rate of return. So I expect mortgage rates are gonna come down throughout 2024 when the Federal Reserve does cut their rates. but I don't think it's going to drop as significantly as people are hoping for. I mean, we could see it down to the fives, but even if the Federal Reserve significantly cuts the Fed's funds rate, there's a little bit more work that needs to be done before we see mortgage rates um, come down significantly. I think. But anyway, let me know what you guys think. Leave a comment. I love hearing from you folks. I love learning about your perspectives, and you guys teach me a lot in the comments as much as I try to share this information with you. I learn a lot from you folks. If you're looking to buy or sell a home anywhere across the country, reach out to me directly. Other than that, thank you for watching, and I'll see you in the next video.